Individual investors, many of whom are first-time traders, are taking advantage of the turmoil in the stock market to open a record number of online brokerage accounts. That's according to the Wall Street Journal. So we want to give you some advice. We want to bring in Courtney Dominguez. Courtney, you're a senior wealth advisor at Payne Capital Management, and you're going to sort of help us if you are tiptoeing into the stock market. And I'm one of those people that actually opened up an online account using an app just to sort of dabble in the stock market. What advice do you give people? Because, you know, things are a little up and down right now, to say the least.
Things are up and down, and it can be a very nerve-wracking thing to say, well, should I maybe wait? Because maybe there's going to be another dip in the stock markets. I hear that a lot. But I would really try to caution here to, if anything, err on the side of taking advantage of the opportunities we have available now.
You know, Courtney, one of the things that I've always found, you know, it can be problematic for investors is that investors, especially small retail investors, and when I mean small, I mean less than $1 million investing in the stock market, that they try to time the market. They try to time the dips. They try to time the highs. And if you look at the stock market historically over the last, 75 years or so, you generally see money flowing into the market when it's really high and money coming out of the market when it's really low because people react to the volatility with emotion. So what do you advise for people if they want to invest in the stock market? Should they be waiting, or should they just, if they've made the decision, they should just jump in?
Actually say jumping in makes more sense here. And here's the reason. If you look at the top 10 bear markets in history, the average return over the next year is over 45%. When you look at the next 3 years, it's over 66%. And that is a lot better than an markets. And so you just want to make sure that you're just jumping in here, because whether we're buying when the Dow's at 18,000 or 23,000, I mean, realistically, this is one of those great buying opportunities of a lifetime, and you just want to make sure that you can capture these prices while they're still here.
So by Vlad's definition, I am clearly not a small investor. I am something akin to a microscopic investor, or maybe something even lower than that. Really just threw a few bucks into it just to see what it was about. And I kind of focused on companies that I liked and companies that I thought would maybe that were dipping now but might rebound later, like Disney. What sort of advice would you give to people who are just playing with maybe, a few $1,000, let's say, and but they want to get involved? They can see that the stock market is really low. How do you make your choices?
I like the idea of buying funds that you like, but with advice to my investors, we want to make sure we're spread out over the entire global stock market. So not just Apple, Microsoft. You want to own all those small companies that are maybe less recognized. You want to own foreign companies. You want to own the whole world. Because realistically, we don't know what's going to come ahead at the end of the day once all of this settles. And you want to make sure you're not overexposed to something that might lag a little bit longer. We're not underexposed to something that might be the best performer. So there's a lot of really good funds out there that can get you started with them. Like, for example, you can look at a target date fund, which owns the entire world, and it targets the date you're retiring. So like if you're in your 20s, it might say something along the lines of have the year 2060 in it, which means that that's roughly the year you turn 65. And it's a good way. It's very risk appropriate for you and very well diversified. I like those, just something to get started. There's a lot of investments out there that get the entire market as a whole rather than picking and choosing companies.
Yeah, that's really good advice. And Anne-Marie, I should point out that, I spent 20 years on Wall Street before I decided to be a journalist. And the terminology of small investor versus institutional or large investor is not meant to say that people who don't have $1 million are somehow small. It is sort of the way that institutions generally think about people who are investing. So yes, small, meaning most people in America, 95% of us are not going to have $1 million to throw into the stock market. That includes myself. But yes, when institutions are sort of thinking about it, somebody who has $1 million to invest and more generally can take on more risk than someone who has less than that amount in the market. And so that's where that terminology comes from. And just in case anybody wants to @ me on Twitter about who's small and who's large as an investor. Courtney, this is really good advice. Thank you so much.
Thank you so much for having me.